Hey everybody, Sabi here, giving you an update. Instead of Elliott wave principles, we will discuss some Wyckoff methodology here. Um, so I had this box drawn when we were in this vicinity, broke down, and now reclaimed the area. The way that you would look at this in Wyckoff terms would be a selling climax of some sort, an upthrust, and then a markdown into a reaccumulation. And that reaccumulation potentially has what is called a show of strength. So that show of strength comes up and breaks the highs and holds at the highs. You don't get any significant retrace that you'd be looking for. It just stays up high. Now that's contrary to the idea of Elliott wave that says that you would potentially be coming down for the A, some kind of B wave here, and C. Now this formation is still plausible, given a black swan event of some sort, which name your catalyst. It's there for you. Yeah, all the stuff going on in the Middle East and stuff. Let it react with the charts. The charts still don't look horrible because price is holding above previous consolidation. So it came down, grabbed liquidity, and now it's holding up there. That doesn't mean that it stays up there. It could swipe the highs, grab this liquidity, and reverse on you real sharply, and then you would be dealing with a larger Wyckoff range. But for now, we're dealing with that as a reaccumulation, where it was reaccumulated at the lows, reaccumulated down here, and now you have a potential show of strength. The show of strength, as it's moving up here, you did have some volume on the pushes up as price went up. And that's mainly probably due to short squeezes happening while price was bullishly consolidating. People were trying to short the market, not believing in the rally, and here we are at all-time highs. Something to take note of in Wyckoff method is the relationship of price versus the volume. And since making all-time high, we've got declining volume, which just today we had a breakout of the volume. Nothing significant, but overall still declining volume, suggesting that this is just a consolidation before resumption upward. You're not having any cataclysmic volume follow through to the downside. And you can see where the volume does pick up here, it's on the lows. Every time that you make a low, volume is picking up, suggesting that that's getting absorbed at the lows. It's even more apparent on the lower time frame, say a 4-hour. Let's actually zoom into a 4-hour. So here on the 4-hour chart, you can see it's still declining volume spike just before all-time highs. Then you had volume divergence, no follow through on that, and volume spikes at the low. Volume spikes here at the low again, and come down. There's another volume spike, and just today, another volume spike, suggesting that that candle was absorption and buying it back. And it did that in a zone of liquidity. So market came back up, back down into this liquidity zone and decided to push back up, take this liquidity, came back down into this liquidity, probably going to go back up and grab that liquidity. And you're really just chopping around in a range that has declining volume until volume steps in and starts breaking this thing out. Now, I'm kind of expecting this to just kind of be a triangle, which is a formation in Wyckoff called the apex. Now, this happens during accumulation and distributions, but for this purposes, since we're having bullishness going into this formation, you would expect bullishness to come out. All consolidations, you would expect continuation versus reversal most of the time. But reversals can happen, and you're on guard for that. But primary expectation is for continuation. So how does it make continuation? Probably through making people think that it's a top, and we have some kind of resistance at precisely 112,000, which I find kind of stupid that price would stop exactly at 112. So I think that's a manufactured top just to kind of flush out some leverage, get people second guessing themselves, and see if they can get price lower, which it certainly can go lower. I'm not saying that it can't. Out of a triangle, which is the reason for triangles, is you end up potentially making a B leg that goes at the end of the triangle and it breaks down. I'd suspect that it goes and takes this lower liquidity if it does, and that would probably be an opportunity before resumption of the upside. But ideally, what I would like to see out of this is for price to go from here and make some kind of triangle, grab upper liquidity first, and take all of these orders, all of those stop losses, and feed them to the downside. Something like this. It comes back down, and maybe it holds 100K. Maybe it breaks slightly below it. It would make sense to break slightly below it before resuming upward, but maybe it does that into the next half cycle low on the daily, and we're just going to consolidate in here, chop you up and down, fake a breakout, come back down into your half cycle low, and then the right translation of the daily cycle leads to your first leg of markup, and then into a declining phase into the daily cycle low, and then markup again. If whatever does come out of here, it may be a fairly large move. I don't think we're at a top, but hey, you can never say never. But the markup phase that can come out of this could be very explosive. Case in point, let's move back to 2020. Just so you have a reference, there is your COVID crash low, and there's the recovery, and then chopped sideways in a reaccumulation formation, show of strength, back up to the edge of the creek, stayed above the price action, very important, and then continued markup phase. But when it came to previous all-time high of 2017, you had this price action. And we could be mimicking something like that now, where price came down sharply, came back up, broke the high, consolidated in a triangle, broke down, made it back up to the point of the triangle, and started to resume above it. And what came out of there was an aggressive markup campaign or continuation of the markup after the accumulation. I mean, that was halfway through the markup phase. Actually, not even halfway. A third of the way through the markup phase before distribution. So if we were to do that in today's terms, that same formation, your B wave would be there, and you'd be coming down for liquidity into that half cycle low, or it'll be a cycle inversion on the daily before popping back up and starting some kind of 1, 2, 3, 4, 5, something like that. So if price does break below the 100,000, even trades below there, I would be expecting 92,000, maybe lower. I do have that 84,000 marked off as, hey, if price makes it down there, there's a reason to buy. Not to say it does happen, but choose your black swan, and maybe we're lucky enough to get down there. So then how do you trade it? Well, your stop loss, you have to manage your risk from somewhere. I would be managing risk from that 100,000 area. Not to say that, I mean, there's a lot of liquidity underneath 100,000. Got to think that does get broken, if ever so slightly. But for now, I think they want to hold price up here and take the upper liquidity first, and then maybe break that 100,000 briefly for the bid cycle low or the cycle inversion. Sometime early January would make sense. And really, it's just a liquidity game. They're just holding price up after a show of strength, convincing people to sell, or telling people that price is not advancing. You may as well get out and see what happens, wait for a breakout, and price will break out without them if price does indeed do that. So manage your risk appropriately. locally here on a 4-hour chart. You can manage risk off that low to take that trade. Now you have to manage risk off of today's low, because if you break that, you're taking out the previous week most likely and coming to check the 100,000. Now, as a Elliott wave pattern, I would just see that as like an ABC coming down, if it does end up getting down there. A back test of 100,000 support, which makes sense. If they want to build that 100,000 liquidity, it would allow for price to build some liquidity down underneath here, so it doesn't have to go much deeper than that. And then from there, price can mark up in a formation like this to just take out liquidity up here, or maybe double top, or take the liquidity. Could see something like that before coming back down to repeat that down here, and then finally take that liquidity before markup. So watch your liquidity. They may just spike it back and forth. There's plenty of narratives out there to move price up and down. FOMC is coming up, and who knows what comes out of Donald Trump's mouth. So yeah, watch your stop losses and make sure you have them. If you're not using a stop loss, you're not a trader. If you don't know where to put a stop loss, that's probably the first thing that you got to learn, is where do I put my stop loss so that's not continuously hit. And usually where people put their stop loss is where it gets hit. So this push up, you had like a breakout. Where does the stop loss go? Right at the low. Where does price target? Your stop loss. So as soon as price came back into this consolidation, it said it's going lower. This is what I'm talking about. When price has a consolidation move, a breakup, but it comes back in and closes a candle, a 4-hour candle in this case, back inside the consolidation, your target should be the lower liquidity. And that happens on all time frames, repeats over and over. So coming out of here, you look for a small little uptrend to start, and you kind of got one starting here. So manage risk off of 103. I'd probably put it right at that, just above the wick low at 103,400 or something like that. If you start double bottoming there, then you're building liquidity lower and you're likely to take it out. So if price does want to push up from here, I want to see it get back up to previous resistance, where it was resistance before, and hover around the resistance 106, 106, 100, where price was kind of pushing against repeatedly. And then you should see price do like an ABC up or something like that. Like similar to this. Price went up, A, B, C. Then we'll just repeat that here. Just probably smaller if I had to guess. A, B, C. And take out this liquidity here at 107, 108. And maybe fakes a breakout. And then you have an ABC up, and then this leg comes back down and takes out that liquidity. And that's kind of how reaccumulation happens. When the volume is hitting at the lows like that, somebody's buying down there, and they're pushing price into their orders. That's what it looks like to me anyway, until it's not. I have seen distributions happen where the only place that they could find buyers was at the lows, so they kept selling into the buyers, and eventually there were no more buyers left, and then markdown phase happened. So if price keeps pushing down, building liquidity lower, then your stop loss should take care of you, and then look for another opportunity lower. Right now, the opportunity would be either this low holds, that was your low, you're going to push up for this upper liquidity, or you're coming 1, 2, 3, 4, and wave 5 comes down to 101, 101,500 or something like that, and takes out that wick. So if you take out the 103,500 wick, you're probably taking out the 102,700 wick and coming down to 101.5, where there was previous supports down there. Previous support could act as support again, if only briefly. You could be double bottoming, like I said, bang, bang, double bottom, start building liquidity under the 100K, pop up, grab this liquidity, feed it to there, and Bob's your uncle. All right, that's kind of my thoughts. What I'd like to see out of here is take out the liquidity at all-time high first, and then come down for the mid-cycle low early July. That would be the most bullish outcome that you could have out of here, because you'd be clearing out the orders from there, so that when price does come down, feed those orders, breaks up again, you've got nothing but clean sailing, and price could accelerate much faster. So have a good night and keep them stops tight.